In this week's video, we'll review the latest charts to help us answer the question, is asset class behavior signaling the next crisis is imminent? In this segment of the video, we'll be scrolling through numerous ratio charts similar to the one shown on the left side of your screen. Therefore, we'll take the time to explain the first set in detail, and then after that, we'll start moving more rapidly. This is a weekly chart of XLY relative to XLP, or cyclical stocks, which tend to be economically sensitive relative to more defensive-oriented consumer staples. Logic tells us if we're confident about future economic outcomes and earnings growth, we would probably prefer to own XLY relative to more defensive-oriented XLP. You can see from the trends here, when market participants started becoming more concerned about future economic outcomes in late 2007, early 2008, the trend was clearly favoring the defensive XLP ETF relative to XLY. We've chosen generic weekly moving averages here for illustrative purposes only. Generic means these are not a set of moving average pairs used by the model. If you're familiar with stock market history, you know the S&P 500 peaked here. So this ratio was waving yellow flags long before the S&P 500 peaked. And we've taken the chart to January 7th, 2008, which is 90 days after the stock market peaked. The S&P 500 peaked in early to mid-October 2007. Why 90 days? Because in the present day, as of April 26, 2018, it's been 90 calendar days since the S&P 500 peaked in late January of this year. And as we can see, 90 days after the peak in late 2007, early 2008, really looks nothing like 90 days after the peak in the present day. This chart is telling us from an intermediate to long-term perspective, we're looking at the trends, the conviction to own growth-oriented consumer discretionary stocks, or XLY, is clearly greater than the conviction to own defensive-oriented consumer staples, or XLP. This really doesn't look anything like this, which tells us something about the market's risk appetite in the present day. And it really doesn't matter whether we're comparing it to the major peak in 2007 or another period. As we scroll through these charts, just think, what are these ratios and trends telling me about the market's current tolerance for risk relative to the market's desire to be in risk-averse or more defensive assets? These charts all help us with the conviction to own growth-oriented, or I'm confident about the future ETFs, relative to the conviction to own more defensive ETFs. Similar situation here. You can see the conviction to own defensive-oriented gold was picking up relative to the conviction to own growth-oriented stocks. This is the look 90 days after the peak. How does the same chart look in 2018, 90 days after the peak? This is a full-bore bearish look with blue, the fastest moving average, on the bottom, and the slopes of both moving averages are down. As of April 26th, this is a full-bore bullish look with blue, the fastest moving average, on top, and the slopes of both moving averages are still positive. Home construction, ITB, in the ETF world relative to 1 to 3 year bonds, or CSJ. Full-bore bearish look and a strong trend favoring defensive assets over more growth-oriented assets. What can we learn about the market's present-day tolerance for risk? If we look at the chart as of April of 2018, This looks a lot better than this. And remember, the important thing here is we are comparing the present day look of the chart. So this box here, how does this look here compared to this look here? Both of them being 90 days after the S&P 500 hit a major peak or a to-be-determined peak here. It's either a major peak or an intermediate-term peak within the context of a correction. The reason why we're labeling this as a correction, based on what we know in late April of 2018, we would classify the present-day move off of the highs in January of 2018 as a correction. Will it morph into a bear market? We have no idea. That's still to be determined, and these charts are helping us assess those probabilities. You may look at this chart here and say, well, the trend is starting to wane. Remember, as we've covered in recent videos and demonstrated with numerous historical examples, humans do like to extrapolate. So we look at this chart here and we say, we know what's going to happen next. It's eventually going to morph into a look like this. That's not wise. We're using these charts and looking at them based on the evidence that we have in hand. We're not using them as forecasting tools. Thus, the proper way for us using our methods and our time frames to use these charts, does this look like this? The answer right now is absolutely positively no. This doesn't look anything like this. How long will that be the case? We have absolutely positively no idea, and thus the need to take it day by day. NASDAQ 100 triple Qs relative to inflation-protected treasury bonds or TIPS. 90 days after the peak, full-bore bearish look. Present day, 90 days after the peak, full-bore bullish look. And this still has a look of a sustainable trend, unlike this period here, where the probabilities are starting to say, pay closer attention, and we do have some deterioration here in the observable evidence. NASDAQ 100 relative to defensive-oriented gold, or GLD, full-bore bearish look, really doesn't look anything like this full-bore bullish look in April of 2018. How about the Dow Jones Industrial Average ETF, DIA, relative to shorting the S&P 500 via SH? 90 days after the peak, blue, the fastest moving average, is on the bottom, and the slopes of both moving averages are down. Does the present day look more like this constructive look here or this concerning look here? The chart in late April of 2018 speaks for itself. S&P 500 SPY relative to investment-grade corporate bonds, LQD. Full-bore bearish, present day, full-bore bullish, and a sustainable-looking trend. How about growth stocks relative to gold? 90 days after the peak, 2007, full-bore bearish. 90 days after the peak, 2018, full-bore bullish. Internet stocks, Frank, David, Nancy, relative to FXE, it's a currency ETF, the euro. Similar risk tolerance look on the right side. This really doesn't look anything, not even remotely close to this. Internet stocks relative to defensive-oriented consumer staples. Blue on the bottom, slopes are down. Present day, blue is on the top and the slopes are up. Internet stocks relative to 7 to 10-year Treasury bonds or IEF. Bearish cross here after the market peaks. We can see this, measure it, and put it in a model. Do we have a similar bearish cross today, 90 days after the peak? The answer is negative. S&P 500 stocks, SPY, relative to 1 to 3 year treasuries, SHY in the ETF world. Similar look or risk tolerance look on the left side of our screen, and a much more constructive look 90 days after the peak in late April of 2018. How about financial stocks, XLF, relative to a diversified basket of fixed income instruments or bonds? Concerning look on the left side, constructive look on the right side. Small caps, IWM, relative to GDX, which is a basket of gold mining stocks. Blue on the bottom, slopes are down. If we fast forward to the present day, blue is on the top and the slopes of both moving averages remain constructive. This helps us with the conviction to be long the S&P 500 relative to the conviction to short the Dow Jones Industrial Average. Soon after the S&P 500 peaks, we get the bearish cross. Present day chart looks quite a bit better. Why are we scrolling through so many charts? Because the model is based on the weight of the evidence. Can we pick apart any one of these charts? Absolutely, positively, yes, because correlations change over time. It's very, very difficult to pick apart the weight of the evidence. The message seems to be clear based on the evidence that we have in hand today. It's extremely important that we continue to take it day by day and not make any assumptions about how long the charts on the right side of the screen will continue to have a constructive and bullish look from a probability perspective. The probability of good things happening over here is quite a bit better than the probability of good things happening over here based on what we can see. Those probabilities have nothing to do with extrapolating. This is a set of facts that we can assess. This is a set of facts that we can assess. Now we'll shift gears to some shorter term charts. This segment of the video is recorded after the close on Friday, April 27th, 2018. This chart is a few minutes before the close, 3:47 p.m. The S&P 500 sat 139 points above the lowest low that was made in February, or the lower end of the range at 2532. When the market comes down here, we have a strong mathematical profile. One of the reasons why we would prefer not to scale out here, A, the math tells us to be patient because the odds at this point clearly favor making a higher high later in the year. Number two, often when you get a plunge decline out of a strong mathematical profile, the first low that you make tends to put somewhat of a floor in the market. So even if you drop a little bit lower, more often than not, it's not much lower than this low here. And so far, that has served us well. If we scaled out from here, that really hasn't bought us too much because the market's basically in the same place. If you sold here, if you sold here, if you sold here, and if you sold here, the market is above all of these levels and has been above these levels the entire time since making this low. As we've described in recent videos, what's different now is the time element is telling us that we somewhat have a time decay and a momentum is waning and our math is waning. Therefore, if we undercut this low, as we've described in the past, we will have to start managing risk a little bit more closely in here. Again, it's not unusual for a market to undercut this low from anywhere to 1% to 3%. So we're going to have to be very, very tactical and nimble if the market decides to move to this side of the orange box, and that is to be determined. We are still clearly inside of a sideways consolidation box or a trading range. While we would all like to have this resolved as soon as possible, it will be resolved on the market's own time. It could take a few more days. It could take a few more weeks. It could take several more months. So the theme going forward, for us, the easy case is if we move in this direction. That's very, very easy for us to handle. If we move in this direction, tactical, nimble, open-minded, push your ego aside. The goal is to get on the right side of the trade several weeks or several months down the road. We don't care if we feel a little bit uncomfortable here with a scale out, scale out, scale out, and then a scale in, scale in, scale in. If that's the right thing to do, we have to do that. That was the right thing to do in 2016. That was the right thing to do in 2011. And that was the right thing to do near the lows in 1998. This case is still to be determined. We'll continue to take it day by day with an open mind. Amazon's a market leader. Let's look at a daily, weekly, and monthly chart. These are all late in the session on Friday, April 27th. The daily chart, kind of ugly here. If you know candlesticks, this isn't a particularly attractive look here. But if we go to the weekly chart, this looks a little bit better. Amazon was down earlier in the week, undercut these lows here, reversed, and was able to finish positive for the week here. On the monthly chart, one big caveat. There is still one trading day left in the month of April. So the look of this chart here will most likely change on Monday. Right now, it has a constructive, indecisive, and bullish engulfing pattern where the market undercut the body of this candle earlier in the month. And now the body here, with strong buying power and a reversal, is engulfing this candle here. It's also noteworthy. We've had a very, very volatile month inside of a range. With 1 day left in the month, Amazon, a market leader, is up over 9% for the month. Moral of the story here, somewhat of a mixed bag. Concerning, a little less concerning, maybe even positive. And this, the longest time frame, which is the most important, right now, if it can hold this look, this is a fairly constructive look on the monthly chart. Just a quick update on our 100 out to the 290-day generic and for illustrative purposes only moving averages. These are the looks that we want to avoid. These are the exact same moving averages as of Friday, April 27th at 3:30 p.m. with the market up 1 point. It actually finished the day a little bit better than that, up 3 points. As we can see, the present day chart looks a lot more like these constructive sides of these charts, and this still really doesn't look anything like this topping look here or this topping look here. Blue, the fastest moving average, is still on top. The slopes of all of these moving averages are up or somewhat flattish. If they turn down, that is not the end of the world. This is the type of look that we want to avoid. Why? Not only can the market fall, but it can fall for a long period of time in terms of duration in weeks, months, and years. We don't bottom in this case until October of 2002, and we really don't bottom because we retest that low in the spring of 2003. Here, we don't bottom. This is late 2007. We don't bottom until March 9th of 2009. That's quite a bit different than your typical dislocation plunge out of a strong mathematical profile that in relatively short order tends to go on to make a new high. Is it possible that this chart is going to morph into something like this? We all know the answer. It's yes, but it hasn't done it yet. These are facts. If we start extrapolating or guessing, we're not using facts anymore. Think about the look of this chart within the context of the asset class behavior that we reviewed earlier in the video. This doesn't look particularly concerning at the moment. The asset class behavior doesn't look anything like the asset class behavior that we had in here. And all of that speaks to the weight of the evidence used by the model. As we've said in the past, the charts consider all topics on all time frames. There's not one question that you can think of that has not been considered by the markets. Fed policy, valuations, the VIX, North Korea, interest rates, inflation, politics. What about the recent distribution days that we've had, or the 90% down days? Do the distribution days and the 90% down days take this chart and all of this analysis and wad it up in a little ball and throw it in the trash can? No, the chart is well aware of the distribution days that we've had. The market is well aware of the 90% down days that we've had. If those legitimate concerns, and those are legitimate concerns, we prefer not to see distribution days and we prefer not to see 90% down days. However, they do occur within the context of an ongoing bull market. If the distribution days and if the 90% down days become a problem, it absolutely positively has to be reflected in all of the data tracked by the model, and it has to be reflected somewhere in those asset class charts. That may indeed happen. The purpose here is not to say that it won't happen. The purpose is to say it hasn't happened yet, and we'll continue to take it day by day. Here are the moving averages here as of Thursday evening, April 26th, and we can see unequivocally the look here looks a lot more like these constructive periods here than these concerning periods here. And we can say the same thing for a very broad brushstroke of asset class behavior that we covered earlier in the video. The charts that we just reviewed and the asset class charts, they do not negate the concerns that we have on the shorter term time frames. And they don't help us very much with what's going to happen in the next 3 days, the first 3 hours, Monday, or even the next 3 weeks. They help us assess the probability of this chart here morphing into a multiple month or multiple year bear market relative to the probability of this being a correction within the context of an ongoing uptrend. And if this is a correction within the context of an ongoing uptrend, we know with 100% certainty that the market will go on to make a higher high. How can we say that? Because if we don't go on to make a higher high, this is not a correction. And eventually this will be classified as a bear market. All of that, correction versus bear market, is to be determined, and that's why we look at the weight of the evidence and we take it day by day. Regardless of the big picture charts, regardless of the asset class behavior, everything that we've said about the trading range applies. We have to be open to all outcomes. We have to be open to price getting down in this area here if it wants to, and we have to remain flexible, nimble, and open-minded if that happens. If it doesn't happen, then life is much, much easier for us. The market will make that call, and it will make it on its own time. Clients and regular viewers may remember in 2017, when the trends were extremely strong as they were in 1995, we continually talked about volatility. Why? Because we know that easier markets are typically followed by harder markets. And when we have an easy market like we did in 2017, it's really only a question of when, not if, things are going to get more difficult. We covered this concept numerous times in 2017, and it's been very, very important thus far in 2018. Question for the market wizards. In other words, in order to score really large gains, like a 375% gain, you have to be willing to see those gains erode significantly before getting out of the market. Answer: I can't see any other way. If you get too careful about not risking your gains, you're not going to be able to extract a large profit. Our goal when we have what appear to be sustainable long-term trends is to navigate between a point A and a point B that could be several years down the road. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.